particular ship.
Understood. Thanks, Robert. Good color, and those are my two questions. I'll turn it over.
Our next question comes from Randy Giveans with Jefferies.
Howdy, gentlemen. How's it going?
Hi, Randy.
Good, thank you, Andy.
Hey, so first on your quarter-to-date rates, much stronger than the negative rates that the headline markets are showing. So with that, should we expect the rest of the quarter to be below these levels, as most of that strength was from maybe December, let's call it? Or are the actual current rates much stronger than the headline rates that we're seeing?
That's a great question. It's a question we ask ourselves. It's because it's all over the place. I mean, you've got extreme volatility now. You actually had a lot of headway last week in MRs, for example, which were starting to trade quite firmly in out of the U.S. side and west of Suez, and was actually starting to pick up a bunch of speed in the east. We're actually even starting to pick up a couple of jet fuel cargoes. We even loaded a big jet fuel cargo for the first time in many, many weeks out of the AG on one of the big ships. And it's literally, you've got this inventory situation. You've got, a very turbulent market. So you really don't know, to be honest, is the answer. As to when the exact time this market is going to, spin upwards. It's very tight. So to work out whether or not the next 50% is going to be the same, worse, materially better than the last 50% is quite difficult. I think that we can be confident that, overall, it's going to be, our overall rates are going to be above, let's say 10. That's going to, and that adds to our let's say NAV value anyway, to the degree that the prices of vessels are not going to go down. But we don't know is the absolute answer in this. But it's just we see it as just time now. These markets are tight, as the winter has shown, and those rates that we're showing are tight. So by saying we don't know, I wouldn't take that as a negative position to the future.
Yep. No, that's fair. Hard to prognosticate from here. Second question, following the vessel sales, which would certainly be accretive if you use those for share buybacks. But your fleet, still massive. Obviously, a little bit of your operating exposure has been reduced. So with that, will you look to charter in vessels to maybe increase that spot exposure? Or, on the other hand, are time charter rates too high, and you're actually maybe looking to charter out some tonnage to secure some cash flow?
We're not looking to charter out, 100%.
Yeah.
We are, and I'll say it for the first time on this call today, and even at the risk of being criticized, we are very bullish, extremely bullish, supremely bullish. Whichever bullish, you want to put, we're there, right? I could say we're bullish 82 times over. Okay? And right. So no chartering out. We are always looking for charter in opportunities. So far, we kind of being disappointed in that sense, because rates, as sale and purchase rates for good quality ships, are actually quite firm. There is it's clearly not only us that is bullish. You have a very strong S&P market, and despite what you've had, even through all of Omicron, you've had a pretty strong forward market, certainly in contango to the spot market.
Got it. All right. Bold up. Noted. James, congrats on the promotion. Great role. Well deserved. Thanks again.
Thank you, Randy.
Our next question comes from John Chappell with Evercore.
Thank you. Good morning. Hey, James. So you laid out a good profile of what's going on with the inventories. I think Robert said something important, which was that the U.S. is basically the only country where you're seeing kind of normalized supplying. Asia's been the big growth area for a long time now. What are you seeing there as it relates to inventories versus OECD, flying activity, other modes of transportation? Is it possible that we're so focused on the Western world coming out of the virus that Asia could continue to be a drag, and that's one of the reasons that the recovery continues to get pushed to the right?
No. I think what's happened with Asia is obviously over the summer, the Delta variant, the Omicron variant this winter, they imposed a lot stricter travel restrictions, and really everything's tied to personal mobility, right, on the consumption side here. When you restrict that, obviously demand goes down. And Asia, though, prior to Omicron, was actually starting to be quite strong again. So I think for the current time, you've got obviously the impact of Omicron, you had Lunar New Year, you've got the Olympics. So I do think Asian demand is going to come back here. I also think there's probably a difficult component to factor in with rising natural gas prices that have affected refineries differently, which is leading to a lot of volatility. But I think looking at the demand side on jet, we're probably 1.5 million barrels away from where we were pre-COVID, but on the water, it's probably only, say, 200,000 barrels. So I think we will see the return here. It's hard. The timing is hard.
I would add, John, to the you yourself, I think, had a really interesting graph the other day, talking about where it showed these real drawdowns that are going on, the inventories. And if you, I think that's something. While we're on it, I'm highlighting you because you really did encapsulate it very well on this table. That there really has been a lot of missing barrels in the demand for tankers, whether it's products or crude, as a result of these inventory draws, and that just can't go on forever. If you simply went to stopping inventory draws, forget about rebuilding multi-decade lows, you would expand even the Asian demand very, very quickly straight away. So,
yeah, thanks for highlighting that. I think the inventories are the most important thing to watch right now, and you could see it even in your presentation. James, for my follow-up, you get the promotion, you get the hard questions. I think there's this view that, an Iranian sanctions lifting positive for crude, maybe not a clear-cut answer if it means anything for product. Also, I think there's been some, a little bit of publicity that if there were a geopolitical event with Russia and Ukraine, possibly good for tanker ton miles, but of course that doesn't take into account what a rising oil price might do. Any work that you've done or thoughts on those two geopolitical events and what that could do to the timing of the recovery or the magnitude?
Sure. When it comes to Iran, the benefit would be increased condensate exports, which would benefit the LRs. It depends where sanctions would be, but certain LR2 vessels will carry that cargo. And actually, there are South Korean petrochemical plants designed to run that condensate as feedstock. So I think it's somewhere around 300 to 400,000 barrels a day of exports for the LR2 fleet, which would be beneficial. When it comes to Russia and the Ukraine, it's hard to say what will happen, but what I can say is obviously Russia is a large exporter of crude oil at 4.2 million barrels a day, and refined product exports probably around 1.5 million barrels a day. Most of this is trading, are going to Europe and Asia, but obviously if there were a conflict, we'd have to factor those numbers into